My first tip-top tax tip for business owners is a really simple one. It's one that a lot of people will be doing already, but not everyone is doing correctly. The first tip is to make sure you take the money out of your business in a tax efficient way as possible. Now, these tips are mainly aimed at owners of limited companies, and if you are the owner of a limited company, the way you do this is by paying yourself a small tax efficient salary and taking the rest of your money as dividends. What do I mean by a small tax efficient salary? Well, you should pay yourself a salary up to the national insurance threshold. Currently that's £9,500. Now, if you pay yourself up to this threshold, the company will save corporation tax at 19% of that £9,500, but you receive it in your pocket, tax-free and national insurance free. And that's the key here, it's national insurance free. If you go above that threshold, your company still gets saved 90% of corporation tax, but you personally pay national insurance at 12% and the company pays it at 13.8%. Therefore, you're saving 90% in corporation tax, but paying 25.8% in national insurance, which just doesn't work. If you pay up to the threshold, the company does pay a small amount of employers' NI, so the threshold for that's a bit lower, but the net saving is just over £1,700. And don't worry, you do still get all your contribution towards your state pension. If you earn more than the lower earnings limit, which is just over £6,000 each year, you get all of the benefits, but without paying national insurance yourself. Any additional money you take out after your salary, you take out as dividends. Dividends have to be taken after accounting for corporation tax, so you can only take dividends up to the level of the profits in your company after that tax. Dividends are a tax efficient way of taking money out of the business. You get your first £2,000 of dividends tax-free every year. As a basic rate taxpayer, you then pay tax at 7.5% on dividends, rising to 32.5% if you're a higher rate taxpayer, i.e. earning more than £50,000. This then rises to 38.1% when you earn over £150,000. Overall, though, dividends are usually cheaper than salary in tax terms. So this is how, as a director, you take your money out of the business. Hope you found that tax tip useful. If you'd like to learn about the other 9 tax tips, please check out our YouTube channel or our website.